If you own gold, silver, or any US dollar asset, stocks included, what's happening right now could either set you up for a once-in-a-generation wealth shift or leave you completely blindsided. And here's the part nobody wants to say out loud. While everyone was staring at the silver crash, central banks were quietly preparing for a global currency reset. Not conspiracy theories, not internet rumors, documented actions by the most powerful financial institutions on Earth. The US dollar's 80-year reign as the dominant reserve currency isn't ending overnight, but it is being chipped away, slowly, strategically, deliberately. And the money at stake? Trillions. Stay with me, because by the end of this video, you'll understand why gold is hitting all-time highs, why silver keeps getting hit even when physical demand looks tight, what a global currency reset actually means in plain English, why the 2026 to 2028 timeline matters more than most people realize, and how to position yourself without panic and without gambling. Quick disclaimer, this is education, not financial advice. I'm not telling you what to buy, I'm showing you what's happening so you can make smarter decisions. All right, let's start with the most obvious evidence. The evidence is already visible. Gold up, silver down, and that's the clue. Gold has been grinding higher. Not a one-day spike, not a meme move, a sustained trend. And people keep saying, oh, it's retail fear. No, this isn't mainly a retail story, this is a central bank story. Central banks have been buying gold at historically notable levels, year after year. And central banks don't buy gold because it's shiny. They buy it because it's strategic. They buy it because gold is neutral, portable, and most importantly, nobody else's liability. Now here's the weird part. If gold is rising because the system is getting shakier, why is silver getting smashed? Pause. This is where most people get it wrong, because they assume gold and silver always move together. They don't, not in the short term. Especially not when leverage and market structure get involved. So let's connect the dots. Why silver crashes like it's engineered, even when demand looks strong. Silver is a smaller market than gold, more volatile, more sensitive to futures positioning, and it attracts leverage. So what happens when the rules change in leverage markets? Simple. When margin requirements rise or liquidity tightens, leverage traders get forced to sell. Not because they want to, because they have to. This creates a chain reaction. Margin calls hit, forced liquidation starts, price falls, more margin calls hit, more selling repeat. That's how you get those waterfall moves that look irrational. And silver is one of the easiest places for that to happen. Now here's the real question. Why is gold allowed to run while silver gets repeatedly slammed? Because gold and silver send different signals. Gold can rise without waking up the entire public. Silver can't. Let me explain. Gold can rise quietly. Silver can't. That's the difference. Gold is held heavily by central banks, sovereign reserves, big institutions, major pools of capital. Gold rising strengthens those balance sheets. Gold rising validates their move away from dollar-only dependence. But silver? Silver is often the people's metal. It's cheaper per ounce, more accessible, and when it moves violently. A parabolic silver move does something gold doesn't do. It screams to the average person, something is wrong with the currency system. Silver is a public alarm bell, and alarm bells tend to get managed until they can't. Now, add one more layer. Even while paper prices get hit, physical markets can tell a totally different story. You can see premiums rising, delivery delays, tightness in immediate supply, strange spreads between get it now and get it later. That disconnect matters, because it ties into the bigger story. The reserve currency system is shifting. Which brings us to the phrase everyone uses, and almost nobody explains correctly: global currency reset. So let's define it properly. What a global currency reset actually means. Imagine a giant global marketplace, hundreds of countries. Everyone has their own currency. Trade gets messy. So the world naturally converges on one main currency used for global trade, commodity pricing, international settlement, reserve holdings. That currency becomes the reserve currency. And if your country issues the reserve currency, you get enormous advantages. You can borrow cheaper, you can run bigger deficits longer. Other nations must hold your currency and bonds. Demand becomes structural, not optional.
For about 80 years, that reserve currency has been the US dollar. A reset doesn't mean the dollar disappears tomorrow. A reset means the world starts building a system where reliance on one currency decreases, multiple settlement paths expand, reserves diversify, confidence spreads across more assets and more rails. And historically, reserve systems change when debt grows too large, money printing expands too far, geopolitical trust breaks, and rival blocs build credible alternatives. Now let's talk about the last big shift, because it's basically the template. The timeline that matters, 1944, 1971, now. After World War II, the world created a system where the dollar was tied to gold at a fixed price. Other currencies were pegged to the dollar. Governments could convert dollars into gold. That worked, until it didn't. Because the supply of dollars grew faster than gold reserves, other countries noticed. They started converting dollars into gold. US gold reserves drained. Then 1971 happened. The US stopped converting dollars into gold. That was a regime change. Gold surged over the next decade. Inflation ripped, and the world entered a new system, mostly backed by trust. Then came a major demand engine for the dollar: oil. If oil is priced in dollars, the world needs dollars. That helps sustain dollar dominance for decades, but that system becomes fragile if energy trade starts settling in other currencies, and that's exactly one of the shifts happening now. So what are the receipts? What are the documented actions? Here they are. The de-dollarization receipts, what countries are actually doing. Don't listen to speeches, watch actions. Central banks can say the system is stable all day, but actions speak louder. Receipt number 1. Dollar share of global reserves is declining. Over the long term, the dollar's share of global reserves has drifted down. Not collapsing, drifting. And a few percentage points doesn't sound dramatic, until you realize that at reserve scale, it's trillions of dollars. Receipt number 2. Gold repatriation. Countries have moved gold reserves back home. Why? Because if reserves are stored under someone else's jurisdiction, they're not fully under your control when things get political. Receipt number 3. Trade settling outside the dollar. More trade corridors are exploring settlement in local currencies where possible, especially in politically sensitive relationships. Every deal doesn't end the dollar, but every deal reduces marginal demand. Receipt number 4. Alternative payment rails. Reserve power isn't just the currency, it's also the plumbing. Payment rails, settlement networks, messaging systems. Countries are building alternatives because dependency is risk. Again, not overnight replacement, but a clear strategic direction. Now, here's where most investors miss the biggest part because it sounds boring: bank regulation. And this is where gold gets an extra structural tailwind. Let's talk about Basel III without making your eyes glaze over. 7. Basel III, the quiet rule change that reprices gold's role. Basel III equals bank liquidity/capital rules after 2008. Basel III is a set of global banking standards designed to make banks better capitalized, more liquid, less fragile in stress. And here's the key point for metals. Basel-type rules can make certain forms of precious metals exposure more expensive to hold on bank balance sheets when they're heavily paper-based or rely on unstable funding. Translation? It nudges the system toward more allocated exposure, more physical credibility, less reliance on certain paper structures. Now, don't oversimplify this into Basel makes gold money overnight, but it does change incentives. And incentives move serious capital. Also important, implementation timelines can differ by region. If some regions tighten earlier and others delay, you can get uneven pressure.
Some banks adjust early, physical gets accumulated earlier, the late movers face tighter supply later. And gold supply isn't infinite. Annual production is limited. Jewelry and industrial demand absorb a big portion. Central banks absorb a big portion. So when regulatory and reserve forces add incremental demand, the marginal price impact can be huge. This is one reason gold can trend up in a sustained way. Now, what about silver? Silver has the same paper versus physical tension, sometimes even more dramatic, which leads to one of the most important signals you can watch, the spread between delivery now and delivery later. Let's break it down simply. 8. Paper versus physical, the signal most people ignore and why it matters for silver. Paper claims can exceed immediate deliverable supply. Modern markets run on layers of claims. That's not automatically evil, that's just how finance works. The system functions as long as most traders settle in cash, few demand delivery, confidence stays intact, liquidity stays abundant. But layered claims become fragile when demand for physical spikes, inventories tighten, counterparties get nervous, and more participants want real delivery. Now here's the cleanest professional signal of near-term physical tightness: delivery now versus delivery later. In a normal market with lots of supply, future delivery tends to cost more because of storage, insurance, financing rates. That upward curve is called contango. But when the price for immediate delivery becomes higher than future delivery, that's backwardation. Backwardation can signal near-term scarcity, immediate physical demand, supply chain tightness, or funding stress. And when silver shows backwardation, it often comes with volatility, because people are scrambling for near-term material. Now, does backwardation mean silver will explode tomorrow? Not necessarily. But it's a serious signal that the physical market is tighter than the paper headline suggests. So now you can see the bigger picture. Gold is being repriced as monetary collateral again. Silver is being buffeted by paper structure and leverage. Physical signals can diverge from paper price. Which brings us to the real investing question. What do you do with this? How do you position without going all in and blowing yourself up? Let's get practical. 9. How to prepare for the reset, without panic, without gambling. Pattern interrupt, direct, calm. This isn't about selling everything and buying one asset. That's not preparation. That's just another form of fragility. Preparation is about optionalities, about being hard to break. Here are the principles. Principle 1. Know what you actually own. Ask yourself, do I own physical metal or a claim on metal? If it's stored elsewhere, do I have direct title? Can I verify it? What happens under stress? How many counterparties are between me and the asset? In calm times, these questions feel annoying. In crisis times, they become the whole game. Principle 2. Understand gold's role versus silver's role. Gold is more widely recognized as reserve collateral, monetary hedge, institutional grade, neutral asset. Silver has a split identity: industrial metal, monetary optionality, higher volatility, bigger upside torque, bigger downside risk. That doesn't make silver bad, it makes silver different. A lot of investors treat gold as the anchor and silver as the torque, but the mix depends on your risk tolerance. Principle 3. Keep liquidity. One of the worst outcomes is being right, but forced to sell. If you have no liquidity and volatility hits, you can get forced into bad decisions, so keep emergency reserves. Not because cash is amazing long-term, but because cash prevents forced liquidation. Principle 4. Expect engineered-looking volatility. Whether it's pure mechanics, leveraged positioning, margin shifts, or liquidity events, metals can move in ways that feel unfair. Your plan has to assume sharp dips, sudden spikes, violent shakeouts, narrative whiplash. If your position is too big, volatility will break you psychologically. Position size matters more than prediction. Principle 5. Watch the 2026-2028 window. Here's why these years matter. Reserve diversification is ongoing. Gold accumulation continues. Alternative settlement systems expand. Regulatory tightening continues in stages. Geopolitical fragmentation increases. Whether a new commodity-linked settlement unit launches exactly on schedule is less important than this truth. The world is building functional Plan B systems, and when Plan B becomes operational, it changes negotiations, even if Plan A still exists. That's what a transition looks like. Slow, then faster. Now let's put the full story together in one clear model. 10. The simple model. Why gold rips, why silver gets hit, what comes next. Model. Liquidity, policy, repricing. Why gold is rising. Central banks are buying. Reserve managers want neutral assets. Debt and deficits keep long-term currency debasement risk alive. Regulatory incentives increasingly favor credibility and stability. Gold has no counterparty risk. Gold is behaving less like a commodity and more like monetary collateral. Why silver gets slammed. Smaller market, higher leverage, more violent liquidations. Paper structure dominates short-term price discovery, and a silver spike is a public alarm bell. In other words, gold can rise quietly. Silver draws a crowd. The tension that can't last forever. If physical demand persists while inventories tighten, paper pricing can lose influence. When physical reality becomes the constraint, price discovery shifts toward premiums, spreads, delivery conditions, and inventory levels. That's when silver can move very fast. Not guaranteed, but structurally possible. And this is why many investors are watching the divergence between paper price behavior and physical tightness signals so closely. Now, what does this mean for US dollar assets like stocks? Important point. A currency transition doesn't mean stocks go to zero, but it can change what wins. Companies with real pricing power, strong margins, low refinancing risk and global revenue tend to do better than assets that rely purely on low rates, cheap debt, and infinite liquidity. So the goal isn't one trade. The goal is building a portfolio that survives multiple outcomes. Because resets aren't single events, they're processes, and processes come with volatility. Let's wrap this up. Closing. Here's the bottom line. This isn't about predicting the end of the world. It's about noticing the transition the world is already making. We have documented shifts, reserve diversification rising, gold accumulation, settlement alternatives expanding, and regulatory changes reshaping incentives. Gold is telling you something. Silver's volatility is telling you something, and the next few years, especially 2026 to 2028, could be the most important window for positioning we've seen in a long time. Don't panic, don't gamble, don't ignore it either. Build optionality, reduce fragility, and pay attention to what institutions do, not what they say. If you found this useful, if this helped you understand what's really happening, share it with one person who's still stuck in the nothing ever changes mindset. Because when monetary regimes shift, the people who do the work early don't just protect wealth, they gain leverage.